Welcome back, ladies and gentlemen. Thank you all for joining me today. I'm not going to dive into anything crazy. I just really wanted to show you what I've been trying to read up on, trying to get a better understanding on, and really just what I can present and give you guys an idea of what I have found. Couldn't tell from the video already, the video title, we're going to be looking at repurchases and really what it is and how it works. The whole goal of this channel, if you're new here, is the idea is I'm going to be learning a ton of things and I just want to share with you along the way. So whether that's investing, learning about investing, learning about different companies, industries, whatever that is, my goal is to really share all that with you. And I really want to get into more of the semiconductors and things in that space. So stay tuned for that. I'm going to do like an industry overview and try to go through some of the big ones. So that way you can learn, I can learn. And really, if you want to see any more of this analysis or just want to read it rather than listening to it through a video or through audio or however you listen to this, make sure to click into my Substack. I try to post everything that I'm looking in, all my write-ups and things that I'm working on. I try posting it there as well. So I'm trying to give the best value as I can to people in their preferred method of, I guess, consuming information. So if you want to see that and you want to see some of the links to things that I talked about here today, make sure to click the link down below in the Substack article. I'll link that there as well. If you have not already, make sure to like and subscribe. If you want to see more content, please let me know if you want to see anything specifically. With that being said, let's dive right into it. So I'm going to be doing a PowerPoint slide presentation, I guess, with myself in the corner. So let's dive right into it. So the first things first, what is a stock repurchase? What is a buyback? You know, you hear these things, but what is it really? So from Investopedia, stock buyback is also known as a repurchase, occurs when a company buys back its shares from the marketplace with its accumulated cash. A stock buyback is a way for a company to reinvest in itself. The repurchased shares are absorbed by the company and the number of outstanding shares on the market are reduced. Because there are fewer shares on the market, the relative ownership stake of each investor increases. And that's really what you saw here at the beginning, this sort of in-out, so your share certificates go in and cash comes out. That's really how this all works. So essentially what happens is, let's say you own 10 shares out of 100 total outstanding shares. That means you own 10% of the business. So that's 10 divided by 100. If the company were to buy back 20 shares, and that means there's only 80 shares outstanding and you own 10 of those still, instead of 10%, it'll be 12.5%. The way that happens is you take the amount of shares that you own and then divide that by the total outstanding shares. You can do this obviously with your actual shares that you own. So one of the great things is how is it even purchased? How does this even happen? Now, there's two methods I'm going to talk about in this video. There's probably a ton more methods. There's a lot of different variations and things, but really these are the two that I wanted to touch on. So the first one is you're going to be doing this through a tender offer. Now, a tender offer allows the company to request a portion of shares from the current stockholders at a specified price range with which the current holders can accept or decline. So it basically allows them to say, hey, we want to buy back at a certain price. If you're willing to give it to us, you can sell it to us essentially at this price. And then you have the open market method, which the open market method basically is how you and I buy stocks. That's how they would go buy stocks as well. They approach an investment bank firm and the firm will do that for them. So think of tender offer as they actually go with an offer, and unless they hit the total that they need, it won't go through. So they need the amount of shares, or I guess the amount of dollars that they're planning on repurchasing with. And the open market is just how you and I would invest into companies, just out on the outstanding shares, the float that is going from day to day. So there's one last thing that I wanted to mention as well. There's something called ASR, or accelerated repurchase notification, and essentially really what this is it's going to tell you a company is going to buy a certain amount of shares within a certain amount of time. So on the right, I decided to look at KLA Corporation, one of the companies I've been looking into recently, and they announced share repurchase authorization along with an accelerated share repurchase. So essentially what's going to happen is, in total, they have $6 billion, and of that $6 billion, they've allocated $3 billion to start repurchasing within the next 3 to 6 months. So the accelerated is basically just attaching a time period to the repurchase versus the actual, if they announce a share repurchase, it can be done in a few months, it can be done in a few years, it can be done over a long time. And a lot of times as they work through it, they might announce more or cut back. Starbucks recently cut their repurchase. So that's one of the great things about the repurchase, is the flexibility of it, but we'll get into that in a second. Now, just going through some history, this was not originally legal. you weren't allowed to repurchase shares. So back in the early 80s, in 1982, the SEC enacted Rule 10b-18, which provides a safe harbor from liability for manipulation under the Securities and Exchange Act if a firm performed its stock repurchase consistent with the conditions of the rule. At the time of its enactment, consistent with the anti-manipulations provision of the Securities and Exchange Act, the Commission intended what became the rule to be a scheme of regulations that limits the ability of an issuer to control the price of the issuer's securities. Now, it ended up in 2003, I believe, they have to disclose it now. So that's why you always see if someone repurchases, they have to disclose it ahead of time. So essentially what you see on the right, though, is just the activity of repurchasing over, really the last 20 so years. It doesn't include 2020, 2021, and 2022's actions, but I just wanted to show you what the repurchasing really looked like over the last 20 years, because I felt like this is really important to understand, and it does change the way that the market moves, because if companies are removing outstanding shares from the open market, that means that the total float that they're operating with is lower and lower and lower each day. So from 1994 through 2018, changes in share repurchases and acquisitions were more significant than the other two methods that are mentioned on the right. And this was especially true in 2008 and 2011. In fact, share repurchases followed the economic cycle with increase and decrease activities as the market goes up and down. This is not surprising, as free cash flow are often thinner in tougher times, and CapEx and dividends are usually higher priority in company spending. So S&P Global actually did a whole study that they wanted to present, and I really took a lot of pieces from this. So a lot of the data you're going to see going forward is from that, and a lot of the graphs and things. I either made, like this one I made myself from their data, or it's something that they had. But really, I just wanted to show you over the last couple of years, really the last 20 or so years, the difference between the CapEx spend, the dividend spend, the buybacks, and the acquisitions, and seeing how those, sort of fluctuate. And it's interesting that dividends kind of stayed towards the bottom of all four, but it is a lot more steady, and it doesn't tend to go down like a share repurchase might, or like, something like an acquisition might. Because if you think about it, share repurchases and acquisitions are kind of like, hey, I have a ton of money, I don't know what I want to do with it, so let's just, put it into acquisitions or put it into share repurchases, which is kind of odd, because you would think that when markets are down, you'd be wanting to buy shares more and make better acquisitions, and when shares, when market's high, maybe issuing a dividend or something like that, where you think the cash might be more useful. But I guess, different things happen, and I guess different logic happens at the corporate level. Now, these are also from that study as well. Now, you can see from the left, you have the dividend yield portfolio, buyback index, and the share yield portfolio. And the three there I want to point out. So the dividend yield, they basically strategize the whole company so that the dividends would be maximized so they can see the actual returns. And this is a total return, so this includes dividends as well. You have the buyback index, which focused on strictly, the best buyback scenario. If you want to read into how they categorize this, it's in the study. And then they had the shareholder yield, which essentially combined dividends and buybacks. So the common equity or common return, I think is what they called it. And then obviously the S&P 500 and S&P 500 equal weight. Now, it's interesting to me that the buyback index did the best on a total return basis, but I guess it kind of makes sense. If you think about it, the companies that are going to repurchase more shares probably have a higher free cash flow to begin with. And so if you think about it, you're going to end up having higher yields on your money as you keep going, or really higher capital gains rather. And they also mentioned in the study that the dividends, the companies that had higher dividends were typically like the financials, or maybe even in the real estate, versus the buyback tended to be in the tech or cyclicals. And it really, that's a piece of it too, in terms of how you're structuring your portfolio is, over the last 10 or so years, that tech has done really, really well in this bull market. So it's not really that surprising. But what I did like was the shareholder yield was higher over the 10, 20, 15-year period. So it's really interesting to see how this gets impacted. And you can see that the buyback index had a higher standard deviation than both the shareholder yield and the dividend yield. So obviously there's some up and downs. And then as well as the risk-adjusted returns on the shareholder yield portfolio was higher on the 20-year. So it is interesting to really see. I thought it was really cool. On the right, you had the source of total returns, and sort of obviously, if you look at the dividend yield versus the buyback index, obviously the capital gains is going to be a big portion of it in the buybacks versus the dividend. And if you think about it this way, the dividend is something that you get in your account and you keep it, versus the buyback. If the company goes out of bankrupt, the buybacks were worth nothing because the company's stock is worth 0 or 1 cent or whatever. But if the dividend, you keep that cash as soon as they give it to you. So that's something I really wanted to point out. Now, there's 3 pros and 3 cons, and obviously there's probably a lot more, but 3 pros that I wanted to go over. The financial flexibility. Now, if there's some sort of issue in the economic cycle, we're kind of in this like super turbulent time right now. Companies can cancel their dividend or cancel their repurchases like Starbucks did, but it's really, really hard to cancel a dividend. And not so much because of the fact that it's, hard technically, but it's because everyone's investing into a company for a dividend. So you think like AT&T cut their dividend, I believe it was either in half or, a fourth or whatever. And a lot of people sold that company off. So dividends is a big piece of why people invest into some companies. It's supposed to be an incentive. So when it gets cut, it's a really big deal. But when someone cuts a repurchase agreement, it's not as big of a deal because in the end of the day, that cash will be used elsewhere. So it's a matter of where that cash gets to be. And the cool thing is too, is that as I mentioned earlier, if you do a share repurchase agreement, it's not accelerated. There's not like a specific time here you're trying to do it in. You have a lot of time that you can repurchase shares. So that's one of the benefits as well. Now, tax efficiency, again, if your capital gains from a share repurchase agreement goes up, so let's say it goes from $10 to $15, that's unrealized capital gains that you're not going to pay taxes on until you sell your stock. So really, a lot of this helps with increasing the stock price without having to pay any sort of taxes. Versus for dividends, as you can see in the chart here, depending on how much you make in your taxable income, that's going to basically be what your dividend tax percent is. So it can go from 0 to 20% depending on how much money you're making. But the repurchases is really the tax efficient way from a lot of people's point of view. And that's the way that Warren Buffett views it as well. He says, that's why they created the B share stocks for Berkshire Hathaway. You have the A shares that are like $500,000, $400,000, and you have the B shares that are like a couple $100. So you basically have your own sort of dividend if you want, and you just sell what you need to sell rather than getting a dividend every single year and relying on that. They would rather give it through capital gains when they think that their stock is lower. Now, the third and final thing that I wanted to touch on was increased ownership and stock price. As I mentioned earlier, if the amount of outstanding shares in total decrease and you still are holding those shares, you now own a bigger portion of the business. Now, from a stock price point of view, if everything else remains the same, so let's say you have a $1 billion valuation and there's 100 million shares. So if you take 100 million shares and reduce that to 80 million, meaning the company's bought back 20 million shares, the share price would go from $10 to $12.50. The way that works is $100 billion, or you have $1 billion divided by 100 million shares, and that's $10 a share. And then you have a $1 billion valuation divided by 80 million shares, and that's a $12.50 valuation. Or at least stock price. So that's the way to think about it. And obviously that's in a perfect scenario where nothing changes. Obviously valuations change on the market every single day. So don't hold that true, but it's just an idea of what you can see from a repurchase agreement. Now, some cons, and these are going to be things, obviously this isn't the entire list of things, but the first thing I wanted to point out was the opportunity cost of capital. Now, the thing is that when you repurchase stock, there's a good chance that that cash is coming from your balance sheet and you're paying for it. And the first thing is from a company level, let's say you might be able to pay your employees more, or you might be able to invest into projects. The thing is that if you take capital out, meaning you take the cash out, you're not going to be able to use that for acquisitions. You're not going to use that for mergers. You're not going to be able to use that for, investing in new projects without taking on debt. So it's a really big thing, especially on the social level as well, where people view it as, okay, they spent all these billions of dollars on repurchases. Why didn't they invest into more jobs, more community things, more projects that will help the greater economy or greater society? So there is a lot of, pushback from that aspect of repurchases, because at the end of the day, the only person that it benefits is the people who own the shares. So if you're not an owner of this share and they're repurchasing these shares, you don't get any benefit from it from a societal point of view. Now, the second thing is the agency problem in terms of, while it's great that the C-suite people and the directors own stock, which they should, The thing is that if it's not really up to the shareholders whether or not a repurchase agreement gets made, it's actually up to management. So if they want to do a repurchase agreement against your better will or wishes, they can do so. So the thing is that you have to make sure that when you invest into a company, you understand what their management is going to do, what their ideas of capital allocation truly are. Because the thing is that at the end of the day, if they own a ton of stock, and you probably as an individual investor probably don't own nearly as much as they do because they get stock-based compensation, if you don't own that much stock, it's going to help them if they repurchase more of their own stock, because their cash and net worth keeps going higher and higher and higher as that stock price keeps rising and rising and rising. Now, this can present an issue if they decide to repurchase rather than investing into new projects, doing R&D or SG&A, so that way they can keep growing the business at a healthy rate. And an example of that really is Intel. Now, Intel was growing, but the problem is they lost market share, and they actually lost a lot of steps along the way to other companies because the management, the old CEO, was focused on giving back capital, or really just giving back cash through buybacks and dividends and all that, which is fine. But the problem is if you're in a competitive environment, it doesn't really work. Now, the third thing that I wanted to mention was a deteriorating balance sheet. And again, as I mentioned earlier, if you don't have the cash for something, you're going to need to take on debt. And in some cases, companies actually will take on debt in order to fund the buyback in hopes that the stock will be higher and higher and higher, and they'll be able to, either have cash later on that they can just pay it back with, or whatever their idea is. I don't really know, but it's probably not a great idea to take on debt just for the sake of buying back your own share. The way that you should look at buying back shares, the way that as an investor you should see management, is they should see this as you would. If I think the company's undervalued, let's buy it back. If I can't find any other better return, let's buy back our stock to reward the shareholders. That's what Berkshire did. They couldn't find any deals, so let's buy our own stock because we think that's the best deal we can give our investors. So it's a way of looking at it and making sure that management is kind of in that mindset as well. But deteriorating the balance sheet is something that can happen, and I posted a screenshot down here that shows when before the COVID 2020 whole pandemic started, the airlines were buying back shares at crazy rates, like billions and billions and billions of dollars a year. They were buying back shares across a lot of the major airlines. Suddenly COVID happens and they don't have any money. They don't have any money to save themselves. They don't have any money to get any sort of, bridging themselves into getting back to better financial economic times. And what ended up happening is we, the taxpayer, had to bail them out. So at the end of the day, and I know part of it's loans, part of it's grants and all that, but that shouldn't have to happen. And obviously, they had to deteriorate their own balance sheet with the loans from the government. So it's not worth it if you invest into a company where the CEO or management doesn't understand why and when to repurchase stock. So that is something that I really wanted to mention. But with that being said, really my final thoughts: if you look into a company, make sure you look at their management, look at the capital allocation that they're looking to deploy. So a lot of times in investor presentations or earnings calls, they'll really explain the idea and the plans from a capital perspective. If you can find that in a management team that's allocating capital and they're very aware of, both R&D spend, repurchasing, dividends, and just making sure that they have cash for the business, make sure that you're looking at that in your management team as you're, researching the company and reading through the 10Ks, reading through the reports. Make sure you understand where all that money is going, because at the end of the day, that is what's going to impact whether or not the company can keep growing and keep going, is their capital position, their liquidity, as well as, how good their balance sheet truly is. And the cash flow statement is very, very useful to understand where that money is going. It explains just about everything in terms of where that cash is going and coming from. So if you have any other questions about stock repurchases, make sure to let me know down in the comments below. But with that being said, I hope I answered or at least brought something new or something you didn't know. So let me know down in the comments below if you have any other ideas. I hope to see you next time. Happy investing and have a great day.